All right, so this next topic is about financing your car. So what we want to do really is to check out financing options. So it's a good idea to get pre-approved for a car loan through a bank or a local credit union before you actually go to the dealer. Then you can compare the loan offered by the dealer to your pre-approved loan. Furthermore, if you have money in hand, sometimes you can negotiate a lower price at the dealership. So that all depends on the dealership and what they'll do with that. Dealer financing costs are often 1 or 2% more than a bank or a credit union. And so that's one thing to think about. And so you really have to pay attention to what they're going to offer you before you decide to take their percentages. Now, what you want to do is shop around for the interest rate. Credit unions traditionally offer the best rates on car loans, sometimes more than 1.5% less than actually a bank loan, and that's even less than what the dealer financing is after you look at their numbers. Now you want to put down as much money as you can, which means you're really borrowing less is how you want to look at it. So you're borrowing less money. So that's going to be a good thing. And then interest rates then are generally decrease as the money you put towards your car increases, or basically less money you're going to be borrowing. Therefore, you're going to have to pay less interest. Interest rates are also typically lower for shorter term loans, and interest rates are lower for new cars than for used cars. So if you buy a new car, the loan interest rates are going to be lower than if you buy a used car. Sometimes it's 3, 4, 5%. Now, as a general rule, you should spend no more than 20% of your net monthly income on a car payment. So that's a kind of a key thing. Figure out what your monthly income is, and you shouldn't spend any more than 20%. Now, do people do more than that? Yes, but it's not a good idea. Now, leasing is a practice of basically paying a specified amount of money over a specified time for the use of somebody else's car. And it's essentially a long-term rental agreement is what it is. So we have two types. We have a closed-end lease where each month you make a fixed payment based on an estimated usage. And then when the lease ends, you return the car and pay for mileage in excess of your estimate. Or there's an open-end lease where each month you make a fixed payment based on the car's residual value. Then that residual value is the estimated resale value of the car at the end of the lease and is determined by the dealer. Now, when the lease ends, you return the car and make a payment based on its appraised value at that time compared to its residual value. Nice thing is if the appraised value is less than uh, not the nice thing, but if the appraised value is less than the residual value stated in the lease, you pay all or a portion of the difference. But the good thing is, if the appraised value is greater than that, this is the good part, then you get a refund, maybe. Not always, but you should. Now, leasing car offers both advantages and disadvantages over buying one. What are the advantages? Well, leasing requires only a small down payment and or no down payment at all. Kind of depends on the lease and who you go through. Now, leasing payments for a new car are lower than loan payments for the same car, which is a good thing for most people. And so most people can lease a more expensive car than they would be able to buy. So is that good or bad? Maybe. You'll look better, I guess, as you drive around, but then, in the long run, it might not be such a good idea. And when the lease ends, you return the car to the dealer and you don't have to be concerned about selling the car. Now, what are the disadvantages? When the lease ends, you don't own the car, you have to return it to the dealer. Now, most lease agreements also have a mileage limit. Usually 12 to 15,000 miles per year is common. If you exceed that number of miles, then there's going to be considerable charges because they charge per mile. When mileage penalties and other costs at the end of the leasing period are taken into consideration, the total cost of leasing is almost always more expensive than financing a car. So that's something to take into consideration. So, it looks good initially until you get at the end and you have to return the car and then pay all those extra things. Now, while leasing the car, you're also responsible for keeping it in perfect condition. Basically, you're liable for any damage to the car. Leasing doesn't cover any maintenance, so you have to continue doing maintenance yourself. And there are also penalties for ending the lease early. Now, insurance. What's the importance of it? Well, when you purchase insurance, you're basically buying protection against loss associated with unexpected events. Now, different types of coverage are associated with auto insurance, but the one required by nearly every state is liability. Now, there are two components of liability coverage. There's this one called bodily injury liability, which covers the cost of lawsuits if someone is injured or killed in an accident in which you are at fault. And there's also property damage liability, which covers the damage to other cars and property from negligent operation of your vehicle. So you're going to be basically paying for somebody else's damage. Now, if you have a car loan or lease a car, you will also need something called collision and comprehensive coverage. Now, collision coverage pays for damage or loss of your car if you're in an accident, whether you're at fault or not, basically. And comprehensive coverage protects your car from perils such as fire, theft, falling objects, acts of nature, and collision with an animal. So that's probably a nice one to have here in Wyoming because a lot of people end up hitting animals. Now, there's a big difference in auto insurance rates. So again, kind of like with shopping for interest rates on loans, you want to shop around for auto insurance rates. So insurance can be very expensive for younger drivers with limited driving experience. A poor driving record dramatically increases your insurance rates as well. Things like tickets, accidents, other things that have happened in the past, those are going to raise your rates. Now, other factors that impact what your premiums are going to be is where you live, the number of miles you drive each year, as well as the value of your car. So all those things are going to take into consideration how much you're going to be paying for insurance every month or every 6 months, depending on how you set up your payments on that. All right, so let's stop there and we'll come back for more.